Let me ask you about hedge funds, right? Do they pay a disproportionate, or do they have a disproportionate amount of space in these markets? If you look at passive investment, it means that you have fewer players on the markets, they're concentrated, which means that it could lead to huge distortions and huge corrections.
No, alternatives are not disproportionately in emerging markets. So if you want to say, for example, if you're leaning this way, have they exacerbated the price action in emerging markets? Are they causing a bubble? No. I mean, the allocation to emerging markets isn't anywhere. It's probably below where it was.
Yeah.
It is on a passive level. So no.
Yeah, I wasn't talking about emerging markets. I was talking about equity markets, all markets in general, Mark.
Oh, excuse me. Yeah, no, the footprint in alternatives remains about 3.1 trillion. It's grown at a lower rate than passives. It's grown at a lower rate than just the S&P index from some underperformance. So, no, we're not worried about alternatives, driving any kind of bubble here. They're prudent. They are making money. They're tactical. And what they're doing recently, going into regional, they've leaned into Europe, oddly, even though the growth is in the U.S. We think that's because of valuation, and that shows a defensive tendency of alternatives to go after something that's on a valuation basis and not momentum.
All right, Mark, talk to me a little bit about what Jeff Gundlach was saying from DoubleLine, right? So he told Bloomberg that this is not the time period where you say, I can buy anything and not worry about the risk of it. The time to do that was 18 months ago. He's much more prudent. Are you much more prudent on the markets? So,
my opinion aside, when we look at the balance sheet that we have, we are cautious about how much collateral, we will need for each asset class. And we're keenly aware of where valuations are. We're keenly aware of where spreads are. So are we at a mature market? Yes. The last default cycle, Francine, was what, almost 9 years ago. So, what Jeff's saying is what I think most risk managers, asset managers are playing.